Hello, everyone, and welcome to my Q2 quarterly conference call. It's Friday, the 24th of May, and I look forward to going over the quarter one of this year, which has been a very exciting quarter for both our portfolio as well as for the markets. Before we get started, I'd just like to remind you that everything on this call is for educational purposes only and should not be taken as financial advice from either myself or eToro. So with that, let's get started. The agenda, if you've watched one of these calls before, we start with an introduction of myself, the portfolio. We do a review of the investment strategy just to refresh ourselves before I have a look at what happened in the market in the last quarter, as well as the portfolio. And finally, I'll discuss the market outlook as well as the portfolio and how it's positioned to take advantage of that. Just a reminder that I won't be having the Q&A session at the end. Thanks to everyone who have submitted their questions. I've just folded it into the presentation where it makes sense. So I hope that I've covered all your questions. If I haven't, please drop me a comment below and I'll be happy to get back to you. So I haven't even introduced myself. I'm Dr. Heloise Greeff. I'm the person behind the Rubymza portfolio. I am originally from South Africa and came to the UK in 2013 to do my master's and MBA and later a PhD at the University of Oxford, where I have a number of patents and publications. I did my PhD in machine learning, so I've been working in the field for the last decade, long before it was as popular as it is now. And I've won a number of prizes for my work related to co-inventing the Oxford Smart Hand Pump and a lot of other work I have done since. On eToro, I have over 175,000 followers. And since the inception of the portfolio, when I became a popular investor in 2019, so in the last 5 years, I've had more than 20,000 people copy the portfolio with more than $50 million. And we'll have a look at how the portfolio has done over that time to make money, both for myself, but also for everybody who joined me on that incredible journey. So, as I mentioned, my financial journey started in 2009 when I did my first investment, but it wasn't until 2016 when I was doing my PhD in machine learning. I was predicting adverse events in patients and mechanical machines, and I was curious to see how I could use those same machine learning techniques to predict adverse events in the stock market. And that's when I started investing on eToro to make use of the predictions that I was getting out of these bespoke machine learning models that I had created. And the portfolio was doing really well based off of these. So in 2019, eToro asked me to make the portfolio public so that people could copy me. And that's when I became a popular investor. And I'm currently one of eToro's most copied popular investors, as well as one of the older, not in age, I don't think, but in at least in time as a popular investor. The Q1 has not only been busy for the portfolio and the market, but it was also a great time where I got to attend a lot of events. I was speaking at the Fulbright event with eToro in March, celebrating Women's Day, about how to get started on investing. And I got to meet a lot of you. So thank you so much for everybody who came up and joined the event. And then a few weeks ago, I was at level 39 in Canary Wharf with eToro to talk about the investing landscape more generally related to capital markets, but also angel investing and venture capital. So, just a quick reminder about my investing portfolio. I am a growth portfolio on eToro, and it's a long only portfolio, which means I very rarely, if ever, take a short position in the market. I recommend that if you decide to copy me, you consider a time horizon of more than 5 years. So that's still usually quite short in the world of investing. And I aim to keep a risk score between 3 and 4, something which I'm very proud of, and work really hard to maintain a steady ship. However, I do add that to the sort of bio page because I think that should set expectations accordingly for the kind of returns that you might expect in a slightly more moderate risk long-term portfolio. So, just a review of my investment strategy. I always say it's the basics and me. So, the basics is my focus on long term compounded growth. It's managing risk according to that aim of having a moderate to lower risk score to ensure that I can reduce volatility. And finally, using strong fundamentals to interpret current economic environments and folding that into the decision making process. The layer that is uniquely me in this whole strategy is firstly, as I said, I developed bespoke machine learning algorithms that help as a decision support tool. It's not a fully automated decision process. I do like to clarify that because if you've watched any of my machine learning master classes, you will know that although I'm very excited about the prospect of machine learning, I'm also cautiously optimistic about how we use it, how we approach it, and recently, more importantly, how it's being used in marketing. So I make it very clear that this is a decision support tool for me and that intuition and my own um, decision making still makes the final decision in this multi-layered process. The second part is using the environment that I'm in. So that's using eToro's low or zero fees to ensure that I can be transparent with my copiers. Copy trading has doesn't pass the fees on to the copier, which is great for the copier, but the platform as a whole also has some of the lowest fees in the market. And finally, my analysis of the hive mind and megatrend, again, using a unique view through AI to see if we can spot long-term disruptive trends and invest accordingly. All right, so with that, let's move on to the market review for Q1. I think overall the global economy remains quite resilient. We saw a lot of positive market returns, strong US economic growth, and of course, if you watched my previous recording in February, we talked a lot about the Magnificent Seven. In fact, the economies remain so strong that we have recently seen a lot of signs of re-acceleration. Particularly, I think manufacturing looks to be recovering after a tough 2023, and forward-looking data is signaling that the expansion should continue for the next few months at least. So taking us through the election year, both in the US and the UK and India. Many countries are having elections this year. Um, so yeah, I think investors really went into the first quarter being very optimistic that a soft landing was in store for the economy, which means that we would ultimately avoid a recession and that inflation would continue to improve and that would result in the Fed starting their rate cutting in March. Not only has the economy been able to avoid a recession, but it's really been tougher than expected. And At the same time, we've seen inflation being a lot more stickier than anticipated, which means that the Fed hasn't cut the rates yet, and that's been at least pushed out to the next Fed meeting in July. But when investors came into 2024, they had priced in 5 rate cuts, which is what we discussed in our previous meeting. And I had said then that it's very unlikely, and it's now looking more and more unlikely. The current market expectation is for 3 rate cuts at best. I would place us closer to 1 or 2 if we're lucky. But overall, Q1 has been kind to investors. The US stock market climbed 10% between January and March, and it's been the best first quarter since 2019. Similarly, international stocks posted returns of nearly 6%. So after starting on a bit of a stumbling block in the beginning of the year, stocks have now officially erased all of their losses from the bear market of 2022, when the US market hit a new record high on January the 24th. And a slew of new highs have sort of followed that index, and it has continued to climb despite unexpectedly strong inflation in January and February. But we have seen that stocks are now about 29% above their lows from October at the end of last year. So the stock leadership for the overall rally has continued to spring from communication, services, and technology sectors, which we discussed in quite a lot of depth last time. The communication sector posted, which included Meta and Alpha, gained about 14.5%, 14.8%. And the tech sector, which hosts Nvidia and Microsoft, rose 13.1%. So that's really been doing a lot of the heavy lifting. But overall, rate sensitive sectors like energy and industrials also drove a lot of the big gains in the market. We can see that real estate, which isn't a big part in our portfolio anymore, slumped, and it was the only one dragging its feet, where it was down 0.7%. But overall, there's been a major reversal from the fourth quarter, where these real estate stocks were doing a lot of the heavy weight. And I think that's largely due to the landmark settlement of the National Association of Realtors, which changed how brokers are being paid. And it's really weighed down on the share price in March. But overall, real estate is still up just under 10% for the year. Energy stocks, which again are not a big part of our portfolio, have also seen a big turnaround. So we can see there's almost no sector that has really been left behind this quarter. But energy sector, which was one of the worst performing ones in the fourth quarter of 2023, has come back in great part thanks to the oil prices ticking higher. And these gains across all sectors have been, as I said, despite the rise in interest rates during the period. And this is unusual because normally rising rates are a headwind for stocks. It's a difficult time for stocks. But the recent upward drift in rates was primarily due to the stronger than expected economic growth, specifically in the US economy. And we've seen this economic strength has increased the optimism around corporate profit growth for 2024, and has really just overpowered investor concerns about interest rates. So the fourth quarter of 2023 saw economic growth of 3.3%, which was stronger than anticipated. But this followed an exceptional third quarter, which resulted in a 3.1 expansion in the US economy for the full year. improvement in the inflation started stalling during this first quarter after it peaked at more than 9% in the summer of 2022. And the consumer price index for inflation fell to 3.4% by the end of last year. But really little progress has been made since then, and the March data show an increase of 3.5%. And this was largely due to the higher gas prices and the cost of housing. Um, housing. Wages have also increased at an annual rate of more than 4%, which have muted the impact on inflation. And this is really because productivity growth, which is defined as the increase in output per labor hour, has also increased. Um, According to the US Bureau of Labor Statistic, labor productivity grew 3.2% in the non-farming sector in the fourth quarter of the end of last year. So productivity gains have really minimized the impact of labor costs on inflation, which hasn't been the case historically. And with the economy performing well and inflation leveling out, forecast for the 2024 interest rates cuts have been moderated quite a bit compared to what investors were expecting at the start of this year, which was about 1.5%. As I said last time, those expectations have been tempered in great part, and I don't expect us to see more than one or two, although the market sentiment is still around 3.25% reductions expectations from the Fed. A handful of the mega cap stocks have continued to lead the market, and this is the Magnificent Seven, which we have talked through before. That's Nvidia, Tesla, Meta, Apple, Amazon, Microsoft, and Google or Alphabet. Um, but since we met in February, those contributions have now become significantly more dispersed, with Nvidia and Meta leading the way and Tesla and Apple really lagging behind. When we met in February, I had 6 of the 7 in the portfolio. I had all but Tesla in the portfolio. I have also since trimmed Apple out of the portfolio in great part due to its lagging effect. The favorite has been Nvidia. As we can see, it has just astounded market watchers. I trimmed down the portfolio position in February, thinking that it's going to fall, which it did, but it's just rebounded again, where we have bought in a little bit more. The shares have climbed about 82% in this first quarter, and the firm contributed about 21% of the market's gain on its own. Other big contributors were Microsoft, Meta, and Amazon, all who are also in the portfolio. In this chart, you can see the percentage of the overall portfolio that's invested, as well as the current position that it contributes. And any disparity usually shows the growth in that position since I have made that investment. So Nvidia, as you can see, originally I invested just, I think, 3.8% of the total portfolio position, but in part thanks to that growth, that is now over 5% of the portfolio position. You will also see that when we met last time, this Nvidia exposure was over 5% of the initial invested position. I have since closed a number of positions because we were just becoming overexposed to technology, and that was driving up our risk. And I was preparing for some anticipation of sideways movement of the technology sector, or these Magnificent Seven, which I discussed last time. So Yeah, as I said, they continue to lead the way, but Tesla, which, as you know, I haven't had in the portfolio for many, many years now, but that was not only the worst performing in the Magnificent Seven, but also among the worst performing stocks in the S&P 500 index so far in 2024, in great part due to weak sales, which have hindered profits and have sparked another round of discounts in the manufacturer's EV inventory. The good thing about this, though, for me, who doesn't quite have Tesla stock, so haven't been affected by it. But the great thing about this correction has been seeing that there is some rationale in the market response, because as you see weakening fundamentals in a company, you would like to see the market sort of responding in a rational manner. And as we know, over the last year, there hasn't been a lot of rational decision making in many parts of the market. So this was good to see, um, that investors aren't just sort of blindly chasing a certain group of stocks because friends are buying it or because it's popular or anything else, but there is actually some strong fundamentals as part of that decision making process. So while the technology leaders have been on an impressive run since the beginning of 2023, the gains have been driven by profit growth rather than an expansion of the price to earnings multiple. Currently, the Magnificent Seven have an average forward price to earnings ratio of about 30 times earnings versus about 18 times for the other 593 stocks in the S&P 500. So expected earning growth is about 20% for these tech leaders, which nearly double the 12% average growth expected for the rest of the index. So that just really puts it into perspective how much of the heavy lifting they have been doing. The current market concentration is much better supported by both profits and growth, which is differentiating, in my opinion, this rally from the tech bubble burst in 2000. So that's in great part why I continue to hold a lot of these stocks in the portfolio in quite a large percentage, which you'll see the exposure to tech has actually increased compared to when we met in February. So that's a review of Q1. Let's look at what is ahead for the market for the rest of the year. As I said, a lot of talk still about the expectation of interest rate cuts, the US presidential elections, but also recently the UK elections, India's having elections. So a lot of movement in geopolitical economies, and we'll talk a bit about how that may or may not impact the portfolio. Um, so inflation and interest rates, as I said, have been main drivers of the stock price over the last 2 years, and I believe it'll continue to be important in 2024 because it has such a major knock-on effect for many other things that consumers and the greater economy, as well as corporates, have access to. Previously, it had been the rise of interest rates that have been our concern, but recently, after the peak of inflation, markets have been anticipating that first rate cut. And ever since the Fed has signaled the end of rate cuts in December, markets have been trying to decipher when the first cut would be. And in the initial euphoria surrounding the Fed's policy pivot, markets were anticipating the first cut to happen in March, as well as hoping for another 6 cuts for the rest of the year. But the Fed has steadily pushed back against those expectations, and they have stuck to their guns. and their forecast remains 3 rate cuts later the year, is all they have said. So we'll have to wait for the next Fed meeting in July. Recent inflation readings come in higher than expected, and markets have gradually fallen into alignment with the Fed's forecast of the 3 cuts. But yeah, when the first cut would happen is led to be seen. And the later it happens in the year, the less likely we are to see all 3 cuts happening. And that's why I'm preparing for 1, maybe 2 if we're lucky. Recently, the Fed raised its 2024 economic growth forecast from 1.4% to 2.1%, and its inflation projection from 2.4 to 2.6%. The Fed Chair, Jerome Powell, noted that growth is expected to be higher because of an increase in available workers, while inflation is being boosted by seasonal issues. Powell's interpretation of the recent data indicated that the Fed is still on track for the first summer rate cut, so July, but we'll have to wait and see. Presidential elections are usually a volatile time for the stock market, and recent elections have been no different, with major parties being more polarized than ever around the world. I think negativity reigns as politicians pull out all the stops to win, especially in the US. The UK have just started their campaign trail after calling elections for July. As uncertainty continues to build over the summer months, investors will continue to get more and more nervous, and markets very often decline in this unstable scenarios. But I've put this chart up to show whether it really matters for portfolios in the long run, because the short answer is no. Election years typically prompt fear that certain candidates' victory will spell doom for the economy and markets, but that doomsday forecasts are about as old as American politics. And thankfully, if we look at market history, it shows a very favorable outcome. So since 2028, the US has had 24 4-year presidential terms, including the current one, and the annualized return of the S&P 500 has been positive during 20 of those 24 terms. And the 4 occasions where performance was negative occurred twice during the Great Depression, the tech bubble collapse in early 2000, and then the global financial crisis in the late 2000s. So under both Democratic and Republican presidents, the stock market has generally performed really well with an upward trend over the long term. And I thought it's really important that we keep in mind that there are a lot of other factors that impact stock market performance aside just those from the US president that's being elected. For example, September 11th attack and the 2008 financial crisis both occurred under President Bush, neither of which he was entirely solely responsible for or could have been predicted. So it's therefore important to remember that even though there will be likely a lot of volatility over the summer, the US presidents and their political affiliation don't make or break the stock market, because the stock market isn't always aligned with broader economic conditions. And for both new president, and that's true for both new presidents being elected as well as incumbent presidents winning, where we can see here over the same period that both stocks and bonds performed positively, both in the election year as well as the first year following the election. The final one, then, as I said, if it's not the president, but it's the economy, then we have to look at the known risks which we might face for the rest of the year, and those remain largely the same as when we entered the year. So as I said, that question around inflation and potential interest rate cuts, China's secular growth and the impact on geopolitics, the Israel-Gaza conflict, which continues, and its potential impact on oil prices, commercial real estate, and playing out whether it's local or systemic. The Ukraine-Russia conflict, is it going to be permanent, a state of perma war? Elections, we've gone over that, and questions about a potential recession, as well as the looming US deficit and a disappearing demand. So with that, let's look at the portfolio performance for this period. As I said, this is a long-term portfolio, and over the long term, the portfolio has positive and negative years, largely positive. 2022 was a negative year for us. The portfolio, for many reasons I have discussed, performed lagged the S&P 500. All of those factors have been accounted for. I went over the learnings I had from last year in the last call. So if you want to know how I have adjusted the portfolio accordingly, please have a look at my last conference call. But that compounded growth and the smoothing of that growth is really important, because you can see how the average portfolio performance begins to pull away from the S&P. So it's just about compounding that growth over the long term. In terms of the risk exposure of the portfolio, when we met last time, I had about 5 to 10% of cash, which was already reduced from the 20% I was holding last year. Currently, I fluctuate that between 0 and just under 5%. So a lot more certainty from my part in the uncertainty about being prepared and taking advantage of short-term positions. And the slightly higher risk exposure has not influenced the overall portfolio risk score, but has resulted in pulling ahead of the S&P, which is the benchmark that eToro uses for its popular investors. In terms of the change of the sector diversification from February till now, you'll see that there's, as I said, a lot smaller cash exposure. It's currently 2.7%. As I said, that's almost 0% on most days. But this immense growth in the technology sector means that we're a lot lopsided towards our exposure in the technology sector compared to the S&P 500, which is something that I am watching closely and continuously readjusting for and moving that around. And I haven't had a healthcare exposure in the portfolio for a while, but changes in the GE healthcare have made me quite optimistic about the company's outlook, and I have brought that into the portfolio as a long-term position. So that is the portfolio positioning going forward for the rest of the year. As always, I will continue to do scenario forecasting to prepare for volatility, dynamic adjusting of the portfolio. As I said, keeping an eye on that growth of the technology exposure specifically. The portfolio will remain net long, and I will continue regular and transparent communication. For you, you can expect volatility, as I said, with the election this year, but in the long term, as we saw, that growth continues to be positive despite the short-term volatility. Review your portfolio, consider stop losses, consider deposit. I made a large deposit in my main eToro account, and I continue to make them in secondary accounts as I want to take advantage of the growth I see coming this year. Finally, just a reminder about my golden rule for investing: patience and discipline. If you've known me for a long time, you'll be bored of my mantra, but that is the core principles on which I have built this portfolio, and I think that's in large part of my success. So, just some final reminders. Do sign up for my mailing list. I'm having more events, so it'd be great to meet some of you over the course of the year or have you attend one of the online meetings. You can scan the QR code or look at the link below to sign up for the mailing list to get those invitations. I've also recently started financial coaching. Some of you asked whether I could do investment coaching, and it's been great to work some of you. So if you're interested in that, get in touch with me. I've worked with a great um, lifestyle coach where we have designed a whole new approach around aligning investment goals and financial goals with personality testing, lifestyle objectives, using a lot more data and personalizing it a lot more than I think it has ever been, which is something that I'm really excited about. So get in touch with me if you're interested in that. And with that, I will say thank you so much for joining, and I look forward to seeing you next time. Keep